All righty, folks, we are going to talk about Q3 business. We're going to get a little sneak peek behind the scenes. We're going to talk about perhaps having 7% mortgage rates in 2025. And finally, we're going to talk about the risk or the benefit of perhaps waiting 30 days on locking a loan, because again, we have a lot of stuff in the next 3 to 4 weeks. We're going to have this conversation with Dustin from Convoy Home Loans. How you doing, man?
Good. How are you?
I'm doing well, man. I really appreciate the fact that you're willing to share with the audience, kind of sneak peek behind the mortgage business, what's going on, refi purchases. Again, this is your portfolio, your business, so it's not meant to represent the country, but it does help my audience really understand what's going on at Convoy. So, what do you got for Q3?
Yeah, I think you nailed it right on the head. This isn't, industry numbers. This is specifically Convoy numbers. So what we did is we ran our Q3 numbers, and I'll just kind of go down the line of the, categories that I thought were, interesting to your audience. So, um, purchase versus refi. You always hear that conversation or
Mm-hmm.
kind of debate. In quarter three, we had 38% of the loans closed were purchases.
Oh,
Um,
wow.
Last quarter we were at 29%. So,
Okay.
I kind of thought they were going to be pretty close because we do a lot of refis. I didn't think it would be, essentially up 33%,
Hmm.
but it is.
Well, that
Um,
actually makes sense because again, we got to remember, folks, this is refi business for Q3. We did have much of Q3 where rates were in the low sixes.
yep.
So again, I talked about a refi boom happening. I do not think it's over, but it existed in these numbers. So maybe that does make sense that you had 62% refis. So that's interesting.
Yeah. And then more interesting, I delved a little deeper on those purchases. We broke it into how many were 30-year fixed debt
Oh,
versus bridge debt, 12 to 24 months, right?
ooh, okay.
Um, 30-year was 78%. So, basically
Wow.
one in every five clients that we were doing purchases for were doing some sort of fix and flip, fix and hold, or
Yeah.
rehab
Well,
project.
that actually just shows the strength of Convoy Homes brand, that you're pulling 1 in 5 loans from true investors, flippers, whatever you want to call them. Yeah, again, you're massive in the SoCal market,
Yep.
and a lot of the big players come to you now. You could bring that same function and experience to the rest of the country, right?
Yeah, we do it all 50 states. Shoot, I should have pulled the numbers. It'd be interesting. We can bring it up next time quickly, but the percentage of loans that we've closed in each state.
Yeah. If you don't know where you went. Oh,
I'm
there he's back. He's
There we
back.
go. That wasn't me. That wasn't me.
I
Maybe
don't know
my
what happened, but
Wi-Fi.
yeah, but the question I was going to ask you, just off the top of your head, instead of saying percent by state, how about just a random guess if you don't have it? California versus all other 49. Any gut feel?
Well, we had those numbers last month through the year,
Okay.
and I'll tell you, I think California was at like 52%, and
Okay.
then Florida and Texas were both at like 16 and 18 or something,
All right. So
and
you're
then
you're 80.
80% California, Florida, Texas,
There you
right?
go. Okay. All right.
No surprise there, but uh, a lot of people live in those three states, so that's part of the reason why.
Yeah, no, it makes total sense. Okay. All right. What other numbers you got? This is fun.
Yeah. So purchases that we did, this one shouldn't be shocking, but it was cool to see. So non-QM, anything DSCR, bank statement, bridge, etc., versus QM. Okay. Uh, 88% were non-QM this year.
Hmm.
84% were non-QM last year. So pretty much identical.
Yeah.
Um,
Okay.
to say why it's up 4%, I'm not going to say there's a reason per se. I think that's
Yeah.
right on par.
Yeah, I'd
Um,
agree.
and then for refinances, of all the refinances that we did, we broke down how many were rate and term, versus cash out.
Oh, I love
Um,
this one. Okay.
Cash out for this quarter three was 64%. Um,
Wow.
but last year was 72%.
Oh,
I think that's a big enough difference to maybe say
yeah.
something was market driven. Um, maybe in my opinion, the amount of deals that you could take cash out last year, where the market, in terms of home values, right, or appraised values or appraisers, uh, allowed for that. But
Mhm.
still, a big amount of our refis, are cash out. We're not refi doing rate and
And
term
again,
events.
typically at Convoy Home Loans, your cash out refis aren't like 10 grand, 12 grand.
No.
These are big numbers.
Yeah, a lot of times we're up against, and this is depending on the loan product. 500K is normally a cap in terms of cash
Hmm,
that you can get if you're above 65% loan to value. Now we can get you 3 mil if the property's worth, 5 mil and not have an issue. But if we're going to 75% and you're getting 3 mil, we're going to cap you on that. So that's
gotcha.
just an
Okay.
interesting
I didn't
little
know that.
tidbit.
Cool.
But this was the interesting number that I wanted to pull, which was those refis, and this answers why so much of the refis were cash out. Is that of all the refis we did, 72% of them were out of bridge debt. So of all the refis we
Oh,
did, 7 of every 10 was from one investor or client that came to us saying, I need to get out of my 12 or, balloon payment coming up. Um,
makes sense.
and that, yeah. And look, I don't know what the number is for how many people told me that their plans were to sell and now they have to refi. But I can tell you that that conversation
It's not
happens
zero.
a lot.
It's
Yeah,
not zero. Yeah.
that happens a lot.
Yeah.
Um,
That's really cool.
Last number I have, not to bore you again with non-QM versus QM, but the amount of refis that we did uh, for non-QM were 76% this year.
Okay.
Last year was 84%.
Hmm.
So we're doing, and I think that might be, a little bit of during the first 3 4 months, QM investment loans had a pretty big difference in rate. Right now, they're
Right.
not, and that might have spurred it. But once again, the summary for Convoy's numbers is we obviously do a lot of non QM,
Mhm.
but we're doing a lot of refis more than purchases, and still doing a handful of bridge versus just 30 year.
I love it. This is awesome stuff, folks. I appreciate all this data. I know you do as well. But just curious, if you were going to ask somebody who runs a mortgage company for some quarterly numbers, I'm just curious, what stat would you like to know? Leave comments below. I will share the results with Dustin and Jonathan, just so we can. I just want to know what's on the audience mind. I'm just curious what
Yeah.
they might be thinking. So again, that was really cool. Thank you for doing that. Let's flip the script. Let's talk about 2025. I have shared with my audience the last 7 to 10 days that I fear that rates for 2025 will even be higher than I expect. And I want to rewind the clock. It wasn't 3 or 4 weeks ago that there were some very prominent folks in the economy, in mortgage, in real estate, talking about mortgages in 2025 being 5.5 and below.
Yep.
You know that I said I thought that was too much. I thought we would be kind of 5.8 to 6.2. I'm now sitting here today looking at what's in front of us, and I, for the first time, have to ask myself, what if I'm wrong? What if we are actually 6.8 to 7.2, right? A full 100 basis higher than I thought just 10 days ago. And again, it's not my base case, but I'm now at least entertaining the possibility. So I'm just curious, when you look at potentially having, let's just call it 7% rates for 2025, how does that hit? How does that feel? How do you think the market behaves?
No, and I think it was maybe a month and a half ago we had this prediction, and you asked me and John, and we asked yourself as well, like, where do we think rates are going to be in 2025? And I think it would be unfair for anybody to be, incorrect on their projections and be mad at them about it, because the market back then was
Oh,
completely
yeah.
different than what we have in front of us right now. But
Agreed.
talking about 7% sounds crazy today if we were telling ourselves we were going to talk about this 3 weeks ago, right? But it's right there, right? And uh, look, prior to October 11th, job reports that came out Friday, 3 Fridays, 2 Fridays ago now. Sorry. Um, the feds and market believed that the feds were going to essentially cut another 3/4 of a point by the end of the year, right?
Right.
Now it's pretty strong. We'll get a quarter point, I think, in November, regardless. But What happens the rest of the year? I wouldn't be surprised if it's zero, right? And I don't think I'm standing alone on that. Um, and that's going to yield a 7% rate very easily, because right now we're at, 6.6, 6.7 on the average 30-year fixed primary. But what
Yeah.
people need to understand is that if the Fed's only cut a quarter point the rest of the year, don't think mortgage rates are going down a quarter point. Mortgage rates are going to
Sure.
go up, because on the rate sheets, we still have it built in. We
Yeah.
were a month and a half ago building in a full point and a quarter rate cut by the Feds from September through December. Right? If that doesn't
Yeah, I think it's
go,
even worse than that, because so you're absolutely right in the short term, and I'll call the rest of 2024 the short term. I think what's even more meaningful is the models I'm looking at, Dustin. They are now taking out 100 basis points in cuts for 2025.
yep,
Think about that.
that's scary, and it leads to what you just asked. What happens if rates go to seven? I think it's very likely. Um, I think 7% isn't a bad number. I'll start with that in terms of my own belief that I've shared many times on this channel for the last 3, 4 years, and that we do need the actual market to stabilize, not from just a supply and demand spark, but we can't go into the same crisis that we had and break housing twice, right, in a
Agreed.
4-year period, which
Totally
would
agree.
happen if we went at the pace that we went from 6.75 down to 6% in the last month and a half prior to going up. If we stayed on that pace and got to 5 in 2025, it would be bad. So if
It'd
you
be
gave me the
disaster.
choice, between 5 and 7, I'll take 7 all day. But sure, transactions for first time home buyers, primary resident stuff, that's going to go down significantly. It's going to turn into just as much of a buyer's market if you're an investor, though. So I think you should be very excited about that. You want
Yeah.
rates to stay high or stay higher longer and not have a dramatic 3/4 of a point cut in mortgage rates over a month, because that's not going to help you as a
Mhm.
real estate investor making the, we'll call it like you call it, insulting offers, right? You're not going to be able to do that if the rates keep going that way.
Yeah, when I think about 7% mortgage rates for 2025, this is kind of how my brain breaks it down. First, refis. Refi boom is dead. I
Yep.
forget who published this. It might have been Realtor. It might have been Lance Lambert at Resi Club. But when rates were below 6.5, there were roughly 4 million people that would have benefited from a refinance, right? Mathematically. Now that rates are up, that has already fallen off a million people and probably fallen off further. So again, I think the refi boom is officially dead and gone, and it's on life support for 2025. Right? There's just not enough people who benefit from 7%. Now there are some life events and some other stuff that will keep it going, but refis in 2025 are dead. Second, first time home buyers. Oh, you were so right. We just got the numbers yesterday for pending home sales, NAR, National Association of Realtors, and first time home buyers have set a record low for percent of purchases. I think it was 26%. If we
That's
have
why.
7% mortgage rates, it's going lower.
Yeah.
And just for context, that number, folks, is usually 40 to 44%. So just to understand how 26% is bad. And I think it gets worse at 7% mortgage rates. The second is, I think new construction, new homes have an unfair advantage, and they are going to do fairly well. Again, pending home sales yesterday, record low since 2010 at 3.84 million annualized sales. Today, new home sales up like 3 or 4% month on month. That spread gets worse. Why? Because new home builders aren't playing with 7% mortgage rates. They will use their balance sheet, they will use their profit margins to make sure everybody's buying at 5%.
Yep.
It's math, folks. They're going to buy more new homes. And then finally, the silver lining for my audience is investors win. Again, I've said it many times. I would love for cost of capital to be 10% for everybody. Why would I like that? Well, first off, demand would crash. I would have less competition. And it would be remarkably easy to find a motivated seller. Because, folks, I don't pay retail. I negotiate. I use disrespectful offers. I follow up. I only need one deal a year Yes, I'm not in fast growth mode, but I'll take one deal a year with built-in equity, with cash flow day one and 30-year debt. A world where rates are higher for longer and stable, investors win. It's just the reality. The last thing I'd want to be is a seller. I would not want to be a seller. You try to be a flipper in this environment, your property better be dialed and unique or entry level housing. I mean, that's the only game in town. So when I think about 7%, I see a lot of downside, but there is that silver lining where my audience, one rental at a time, we win. We win in an environment like this. So that's how I break that down.
I couldn't agree with you more. The silver lining on all of it is it is the best market if you are an investor to have rates be at 7% next year than 5 or 6%, right? It's simple. The amount of demand when you're competing against, let's say, 20 different other offers when rates are at 5.5 or 6.5% versus you might be the only offer in town when rates are at 7.25, and the seller's got to sit there and decide, all right, I'm gonna have to go lower than I wanted to, or maybe I'm gonna have to carry a note. And those are all benefits that we've spoke about many times here that just benefit the investor.
Yeah, again, folks, when you're playing in this environment, please understand that maybe you could give them their price, but they carry some paper, a second. Maybe they take a sign. It's just the investors win. We can be creative. We can use our buying power in an environment. If we have 7% mortgage rates, I'll say it right now for the first time, the buyer's market that I'm telling everybody we're in right now, it will extend at least through the summer of next year. This is a real problem, right?
Yep.
We have 7% mortgage rates. Again, we'll see if they stay there because, again, our third and final topic is waiting till after the elections. We get a jobs number. We get another inflation print. We get a Fed meeting. We get a lot more Fed talk. And I think they're going to start to influence rates. I don't think the Fed is happy that mortgage rates went to 7% after their cut. They're like, dude, what the hell happened? Because they're cutting because they're too tight. And the fact that mortgage rates went up 90 basis points didn't make it looser. It made it tighter. So what do you think about waiting till after the election? At this point, it's 2 weeks away, but there's a lot going on in the next 2 to 4 weeks.
I've always been one, and I've never said anything different on this channel than if you like it now, to lock it, right?
Lock it. Yeah.
It's not worth the risk reward is not there on the reward side for you to float. But this may be my first time saying it. If you have a loan application that just started, and we're talking about locking in 15 days versus 30 days or 45 days, that's a conversation that you need to have with your loan officer. And whether it's a purchase or a refi is also going to determine how quick you got to lock this, right? Your close of escrow date versus refi, you can wait 2 months. But I had a little bit of change in stance, and it is risky because of the job reports next week and the election, and the economy being more robust than the market had thought, and inflation fears coming back. Now, I'm not going to get into uh, politics or election talk here, but sure, a little bit more is pinned on Trump with his loose tariffs, and sure, he might be the small odds favorite. But if history shows itself, I believe there's going to be a little bit more of a slow, gradual increase on rates until the election happens. And then for the next 30 days after the election, I think it will come back down. It's not going to come down a lot. I don't expect it to come down a lot. But I do feel very confident that after the election happens, whether it's a month after, or 2 months, or 3 months after, that rates will be zero point 0.1 or zero point 0.2 lower after the election than what they are right now.
Yeah, I mean, we have seen, even the Fed beige book. The Fed beige book had 18 mentions of people waiting for the election for hiring or investing or all of this. At this point, folks, we're less than 14 days out. Again, it's always gambling. It's always risky. This is not financial advice, but frankly, what would I do? I'd wait till after the election. I just think there's so much uncertainty. And again, uncertainty in the mortgage market, AKA risk premium.
Yeah.
What squeezes out risk premium? Certainty. What squeezes out certainty? President election. We know who it is. We're done. So again, when I look at the risk variables that are likely being added on to mortgage, aka the spread, it's probably a little bit fatter now than it will be post-election. That is just one man's opinion, one man's guess, not financial advice. But I think makes logical sense. Right, Dustin?
You nailed that as far as you could, right on the head, dead middle, right on the head. Because a week and a half ago, believe it or not, we've been selling to this one hedge fund on Wall Street for the last 3-4 years, and our spread, okay, between the 5-year Treasury, right, and the rate that we would offer to our clients. Now, every rate's different depending on the LTV, yada yada, right? But our spread went up 0.15, and John and I were like, what happened here? And guess what? Well, we got to build in a little bit of risk premium until the election happens.
There you go, folks. This is going on right now. Again, folks, as you saw in the opening video, Convoy Home Loans serves all 50 states. Purchase, refis, bridge debt, they can help you. DSCR, conventional, they are a great place to be. If you look at the screen now, you just go to convoyhomeloans.com, and there's a little drop down that says they came from ORAT. Why do you have to say that? Well, if you say you came from ORAT, you either get this fine gentleman, Dustin, or his partner, Jonathan, or you don't pick it and you end up in a queue with all the plebes. You don't want to be with the plebes. Work with the guys at the top. Dustin, have fun. Thanks for your time.
Thanks, Mike.
Uh-huh.